This episode may or may not be fully generated by DeepSeek. Welcome to the second episode of Kurv Your Enthusiasm. I'm one of your hosts, Howard Chan.
I'm Dominique Tersin, the other host.
This podcast is a discussion of everything relating to investing and everything adjacent to it. And Dom and I are too interesting to be replicated by some inference model. But before we start, it is important to remind the listeners that the trades that we discuss on the show are not meant to be financial advice because everybody's financial situation is different. And we're recording this on Friday, January 31st, 12:30 p.m. Eastern Standard Time. So Dom, I guess today's episode, we're going to go through some market update. Then we're always planning to do a tech outlook because we manage some tech-focused ETFs, but it seems like market did that for us. And lastly, we will have a trade of the episode, and it would be a Bitcoin arbitrage trade. So Dom, been a pretty quiet week, huh? Since we last did our episode.
Yeah, so for the past 2 weeks, we saw some volatility in stocks, but actually net, they are net positive for the S&P, 1%, not too bad on 2 weeks. And the Nasdaq was actually slightly up 0.3%. In a way that reflects some kind of rotation out of the top holdings into the rest of the market. What we can see away from the stocks, gold plus 3.5%. It's relentless. It's now reaching new highs again. We have oil down 6% on the back of the baby drill of the new administration, right? That the dollar index is also down 1%, and combined with the oil, that can explain 10-year treasuries yield that is down 10 basis points over the last 2 weeks. How about in terms of events? Well, the events after the inauguration, we had the earnings seasons for the tech sector.
We picked it today to release and record our episode. Strange, very strange.
Yeah, Netflix announced better revenues. The stock did very, very well, plus 13% on 2 weeks, actually 10% in 1 day. Tesla had less revenues and less profits as well. The stock is down 6% on 2 weeks. We had Microsoft as well. I think they did less well on the cloud. And Apple as well on the revenue, slightly down. Oh, no, 2 days ago, the Fed maintained their Fed fund target rates between 4.25 and 4.5%. In a way, we were right?
Yeah, if we could figure out how to do graphics on this, then it would be a 1 for Howard and a 1 for Dom on the screen.
But yeah, one and one, that was an easy one because the market was pricing at 99% probability of a pause. That said, to our credit, we did also say that there will be less than what the market expected 2 weeks ago through 2025. And in a way, that's what we can see. The DEC future of the Fed fund is down 6 basis points. So for now, we are on track. But now what I want to focus on 2 other events that happened in the last 2 weeks and are important for the tech sector. The first one is Project Stargate. So that was announced after the Trump inauguration. This is an AI infrastructure initiative with a joint venture between OpenAI, SoftBank, and Oracle. And they plan to invest $500 billion over 4 years to do what? Data centers. That's a lot of money, right? What do you think about that?
Yeah, I think it's always good to kind of size these dollar amounts because, people throw billions and now even like trillions around, and these numbers are so big, sometimes it's hard to get your head around. So the announcement was they were going to spend $500 billion for the next 4 years to build data centers in the US. And it's just sort of seen as a triumph for the Trump administration, given this investment in America. But if you take a look at it, that means about $125 billion a year. So let's just size that a little bit. So this year alone, Meta had said that they're going to spend 60 to 65 billion to build AI infrastructure, which is mostly data centers in Louisiana. Similarly, Microsoft has said that they were going to invest 80 billion to build out more data centers. So from the spend, the project Stargate, which is a good movie, by the way, $125 billion a year is less than essentially the spend that Meta and Microsoft put together. So if you think about it, the people who came together, it makes sense, right? Microsoft is an investor in OpenAI, but Microsoft doesn't just want to build for OpenAI, and it makes sense for OpenAI to have some of their own infrastructure. And Oracle, who wants to be more involved in AI, is part of this group. And then SoftBank, of course, earlier this year had already mentioned that they were going to invest $100 billion into the U.S. economy. So in some ways, I think this announcement is a little bit of a nothing burger because they're just rewrapping planned expenditures into this announcement. Data centers are an important component into supporting the AI revolution. And I just have some numbers for folks to gauge what that means. In 2024, there's about 12,000 data centers around the world. In the US alone, there is about 5,300. So that's about 45% of the world's data center is in the US. And China, by comparison, has about 450. That's about 4% of the world's data center. And the rest of the world is about 6,000. So half is distributed across the rest of the world. The US is already in the lead in terms of the number of data centers and being able to rent out those data centers to move forward this AI revolution. And so this will just further push forward the United States lead in this sector.
500 billion, it's all in the US.
It sounds like it, although there was sort of a little bit of a housewives of Silicon Valley, depending on who you hear, they may or may not have the money. In terms of sizing, it is comparable to what a couple of large tech companies would spend to build out infrastructure. So it's nice, but it's not game changing. Yeah, it was a big news. And before we get to DeepSeek, our intention always on the second episode was to talk a little bit about our tech outlook for 2025. And tech is not just AI, it includes car companies and media companies like Tesla and Netflix. But given the news, I think today we'll focus on AI. We could do a whole episode on just Netflix, I think. That I think we'll push away to a future episode. Sometimes good to have a framework in which how do you think about AI. And just like a personal story, I was trained as a computer scientist, electrical engineer. And so I have actually taken some artificial intelligence classes, and you learn about building neural nets and training them through forwards and backwards propagation and then different layerings to have the different weights. This is stuff that I think I learned maybe like 20 years ago. When the recent AI revolution came out, I was kind of shocked. I was like, oh, what has changed? And I reached out to former classmates who are really deep in this field. They did say there's better statistical methods, but the two things that really changed in the last 20 years is the availability of trainable data and the amount of compute that is available to build and train these models. In different forms, there's inference models, there's large language models, different techniques. And so the way I look at the AI complex is to split it out into the hardware infrastructure and then the software layer. The infrastructure largely includes two groups of companies, the chip makers, but then you also have the cloud providers who allows you for distributed computing. Okay? So the chip makers would be, the likes of Nvidia, Broadcom, AMD, Qualcomm, even data centers, stuff like, Oracle. And then the cloud provider would be AWS from Amazon, Azure from Microsoft, and obviously Google Cloud. The software layer are those companies that don't necessarily have their model, but uses it to monetize, right? So those are companies like Apple, Adobe, Salesforce. And then you have some companies that's sort of in between, like Microsoft. They have their own model, but they also have infrastructure. Google has Gemini, but also has Google Cloud. And of course, Meta has Llama and is actually building out more data centers. Our outlook, at least at Kurv, is that there is tremendous demand that outstrips the supply of these infrastructure pieces. And so we continue to see that the earnings for both the chip makers and also the cloud providers to continue to have pretty good earnings going into most of 2025. One thing that we are cautious about is you see this cycle in semiconductor companies, which is like in the beginning of a cycle, there's this demand for chips. And then over time, more and more players get into producing these chips. And then there's becomes an oversupply and it becomes too cheap and it's not feasible for these semiconductors foundries or producers to make these chips, and then a lot of them fall away. And in fact, that's how we kind of went into this single foundry kind of model, right? So we are on watch for that, but I think we're not quite there yet. So at least for the first 2 quarters, we just still expect that the infrastructure play to be pretty strong. Now, there's a question of whether those even really good earnings can meet market expectations, right? In the last quarter, Nvidia had great earnings, but the stock still suffered because market expectations were too high. So that's something to monitor. The question mark that we have is on the software layer, which is once the models are trained and able to produce good results, how are companies actually going to be able to use them to increase productivity or earnings, right? And we've seen different companies taking different models. With Meta, we've seen some initial green shoots. They've used their models to better target ads to their users, and it seems to have added to both the top and bottom lines. Apple has sort of taken, well, I would say iPhones with Apple Intelligence, they've been releasing features over time, and I don't know what the end goal is, but they generally seem to be pretty model agnostic. They have an agreement with OpenAI, but they're really not heavily investing into building the models. They're basically renting out models from other folks. So let's see, maybe that is being the rail of this ecosystem. Maybe that's the way to go. And then you have this innovator's dilemma that's happening with Google, right? I think most people who do search now can see Gemini, and Gemini actually gives pretty good results when you search for something. And I now hardly actually have to click into the individual links that it provides. So that's sort of a threat to the existing ad business, click-through
That's
business.
true.
Yeah. So we'll see how Google, deals with that. So that's been our framework, a strong infrastructure play, and then less straightforward with the sort of the software layer. Now, as you mentioned, over the weekend, or at least Friday after market, we got this news about DeepSeek, specifically the R3 model, which came from sort of a research paper, and then there's a model that you could use. And what they claim was that they spent less than $6 million to train their model, and they used about 10,000 older generations of Nvidia chip to create this new model. And it seems like on the surface, the efficacy is similar to one of OpenAI's products. And what the outcome of that is that Nvidia fell almost 17% on Monday, which wiped out almost $500 billion of market cap. That's pretty extraordinary. So I have to say, I have some views that's a little bit contrary to the market. One is, I don't know how much of this research paper can be verifiable, right? They mentioned it took less than $6 million to train this model or to build this model, but they don't really talk about how much money actually went into the research to get to that point, right? It could be much more. And the fact that they can't really say that they have access to the latest Nvidia chips because there's obviously sort of an embargo, right, to go into China.
Apparently, they will go through Singapore or something.
So the argument would be, even if they spend a little bit more, they probably haven't spent billions like OpenAI, and so that cost improvement is a boon to the whole AI sector, right? And I tend to agree with that, but I want to just kind of step back and take a perspective, right? So from a competition standpoint, Nvidia's stock dropped 16%, which only brought them back to where they were in October. So it's not like the company's completely destroyed. And if you say, okay, maybe their future earnings dropped by 16%, that's not that unreasonable. But I think the key point that I take umbrage with what's happening or with the discussion that's in the market is they're focusing on dollar per compute. The cost of compute has gone down dramatically. And the theory is that, well, if the cost goes down,
the token per dollar.
Yeah. So if it's so cheap and you can spend more, then that makes OpenAI's it questions how much investment you actually have to put build into these models, right? But actually, I want to take the inverse. Instead of like dollar per compute, I want to think about compute per dollar, right? That means for every dollar you spend, you can get a lot more compute, right? And I think about compute as sort of like energy. But maybe an example is like, I have never met a person who will say, my computer is fast enough. I'm satisfied and I don't ever need to upgrade again, right? I think as soon as you have more capacity, more compute capacity, people will find ways to use it, just like energy, right? The more efficient we create energy, people find other ways to use that energy.
Especially in AI, right? Which you need to train larger and larger amount of data, I guess.
Yeah, and also more importantly, if it's cheaper, then more people can find solutions, more people will use it. And that increases actually the demand, which means that you still need really good chips to have good efficiency chips. And it can be that, Nvidia doesn't suffer, maybe have increasing demand, right? And of course, other players will then come into the space. So I think that's something that has been overlooked in the market. And I think the counter to that is, in the market when Nvidia fell 16%, the one stock that actually was green that went up was Meta. And people were saying, well, they went up because they've proven that, the open source model is the one that's working. I actually think the other way, right? So now Llama, which is the Meta's model, now have serious competition. A competitor in China just released a model that is direct competition, open source competition against Meta. And of course, it's open source, so Meta can look at the techniques and copy it, and then other way around. And what is the commoditization of these open source models, right? Maybe there's some secret sauce for the closed loop ones like OpenAI that they can better manage the sort of the technique. So in some ways, I think the market sort of got it backwards. I feel slightly vindicated because like Thursday night, both Meta and Microsoft released the statements like, oh, they use interesting technique, but it's really nothing revolutionary. They're sort of talking their books, right? So we'll see. I think I have a little bit of a contrary view to the market, and I think the big question is whether this dip from Nvidia is a permanent impairment on future earnings, or is this a buying opportunity? And I tend to be biased towards a buying opportunity.
Yeah, because we can see all the software are in blue on our spreadsheet, and the hardware were mostly down.
The thinking is that the software like Apple, they haven't had that much total expenditure to build these models, so they should be in a better position. But I don't know, actually. Another thing that requires a lot of compute and calculating of keys and hashes is Bitcoin. So the trade of the week is a Bitcoin arbitrage trade. So just for people who are not familiar with arbitrage trade, it's very simple on surface, but the technicals, it could be a little bit complicated. But an arbitrage trade is essentially an asset has two different prices. And what you would do typically is you would long the lower price asset, and then you would short the higher price asset in the hopes that over time, those prices converge and you can benefit from both legs. So Dom, I'm going to turn it to you. And how does this express itself in Bitcoins?
Yeah, in theory, with your explanation, if you want a risk-free arbitrage, you will use the same asset. And in the case of today, the trade is you buy spot Bitcoin and you sell Bitcoin futures, June, May, April. Bitcoin is traded in cash on the different exchanges, but other exchanges where you can trade the futures on Bitcoin. which is you purchase or sell the price forward. So in March, in June, or September. What we can see from the price, like today, or actually it was this morning, there's large differences. So the spot, for example, was $105,000. Okay. But the September or the June contracts was $108,000. So that's our $3,500, okay, of the price difference between the two. And the only difference is, while one settles today or tomorrow, the other settles in June. But it's the same Bitcoin. What can explain the difference? Well, if you buy your coin in cash, in a way, you have to compare it as if you were borrowing money, right? So you would borrow money at the risk-free rate, which is 4.3%. And you need to compare that. So what is 105,000 compounded at 4.3% over up to June? And you compare that with the price of the future. And there are still some difference. The difference is about, should be about $2,000. Okay. And what can explain this $2,000? So that's, in a way, the arbitrage of the trade.
So just to recap what you said. So essentially, typically, future prices is what your spot price times a risk-free rate over the period that you're looking at the future, right? So if you have June future is the spot price times what interest you have to pay to borrow that cash to buy that spot right now. And that should be the same price.
Yeah. When you buy the futures, you don't have to use any cash, right? So there is an implied financing rates in it. In theory, if there is no cost or risk to that trade, you will just have to pay the normal risk-free rate that is in the market, like T-bills or things like Fed funds. So around 4.3%.
That calculation is different than what the future price is.
Yeah, right now the implied financing rate in average is 10%. So whoever buys a future rather than the cash will pay 10% around, it depends on the contract, but around 10% cost.
So if you're long the spot and short the future, you can lock in that 10%.
Exactly. You can lock in that 10% yield. Part of it is the risk-free rate, so 4.3%, and the other is a spread over that risk-free rate.
So it's a little bit strange, right? Because usually arbitrage trades, they come and they go. Because once there's some mispricing, a lot of capital would go in there to do this trade, and the pricing would be arbed out, right? That's a common term in finance market. It would be arbed out, and the same asset with two different prices should converge. But the strange thing is this difference has actually occurred maybe since the beginning of the futures market for Bitcoin. So why has it been so persistent in terms of this mispricing?
Yeah, it's true. When I started to look at it, it was around the 20%. And after it went to 10, and since a while it has been 10%, and it's persistent. I think there are a few reasons. People prefer to buy the future than the cash, because when you buy the futures, you don't have to store your Bitcoin. So there is some kind of storage cost associated to it. Or people can say, well, there's no cost when I buy my Bitcoin and I leave it at the exchange, right? Well, it's true, but there might be risks to it. Some people would prefer to move their Bitcoin in a cold storage wallet on a USB stick. What happened of the USB? I think some institutional now have a safe for cold storage on USB stick somewhere, like a Fort Knox for Bitcoin. But still, it takes a while to, you have to buy the Bitcoin, borrow the money to buy the Bitcoin, and you have to place it on a USB stick. So that's difficult. So there might be a way for that. The other reason is collateral. So when you do a future contract, because you don't have to, because you are borrowing money in a way, you have to put collateral. And usually the collateral is, I would say, between 30 and 50%, depending if you're retail or not, or large or small. And that's money that stays in an account. You have to take that into account. Does it pay interest or not? And on top of that, you have to take into account the margins, right? Your margin, if tomorrow you are short the future and the future goes up, you lose money, you have to put margins against it. So you have to be able to face any movement of cash around, and that has to be taken into account in your calculations.
So if the price of Bitcoin goes up, you actually have to have more liquidity because you have to post for margin. So
Exactly.
it's not something where if you don't have liquidity, you can necessarily do this trade for a long time.
Exactly. You have to be able to move money around. You have to have a lot of liquidity. In theory, if you take that into account, the rates that you see, the 10%, might be less.
So it seems like the inefficiencies in the spot and futures market be able to switch between the two would have led to this sort of implied financing yield in this arbitrage. Yeah. Well, that's really interesting. And I hope you guys enjoyed it. If you guys enjoyed this episode, please like the episode so that other people can find it. And of course, if you ever have anything that you'd like us to cover and to talk about, please send an email to podcast@kurvinvest.com, KURVINVEST.com. See you at the next episode.